Andrew, I want to go all calculus on you. We can do that with your mathematics, which is the rate of change and the rate of change of the rate of change. Let's assume the President of the United States is oblivious to calculus. The rest of us are not. What are the accelerative tendencies right now that you are watching?
Well, I think it really is this tension between a rate market which is increasingly confident not just that the Fed will cut rates, but that the Fed will cut rates significantly. I think that's very much what the kind of accelerating kind of down momentum in the chart you just showed shows. But, comments, very recent comments from the Federal Reserve that they see the outlook for rates as relatively balanced, an unemployment rate that's still at 3.6, that's still very low, core U.S. CPI that's at 2.1, and financial conditions in the U.S. that are still very easy, right? Remember, the Fed used a big tightening of financial conditions early January as justification for that big change in policy. So I think this is another, I think, potential kind of risk to the market that you have. On the one hand, markets increasingly confident that the Fed is about to jump in,
right?
But a number of hurdles potentially to that.
Well, let's cut to the chase. Bring up the chart here, and there's only a money question this morning that everybody on Global Wall Street wants to know. This is a WIRP function. This is the chart that Vice Chairman Clarida. Oh, did I misspeak? I said Chairman Clarida. Wrong. Okay, Vice Chairman Clarida alluded to yesterday. Andrew Sheets, middle of April. Andrew Sheets, middle of May. We're now up to near 100% likelihood of a rate cut out to January of next year. The Fed's fighting that with all of their might. Does the news flow of the last 12 hours change what Chairman Powell must do?
Well, I think this is the difficulty, right? The Fed has been very clear that it wants to be data dependent, and it's not clear that you've seen enough shift in the data to warrant a dramatically different stance. Now, again, the Fed is free to do whatever it wants to do. If it feels that there are risks that aren't reflected in some of that incoming data, then it certainly would be free to cut. But if you look at financial conditions, they've been tightening some, but they are nowhere near kind of as tight as they were kind of around the turn of the year when they executed a big change of policy. And then if we look at kind of the classic kind of big two pieces of data for the Fed, the unemployment rate and the rate of inflation, both of those things are kind of healthy still. I mean, inflation's dipped down a little bit on core PCE, but it's ticked up a little bit on core CPI. So I think next week's payroll numbers can be very important for that debate. I think the incoming data will be very important, but I think the Fed is actually in a pretty tough position here, given, as you mentioned, the market's priced in a 100% probability close to of a cut.